What's up everyone, it's Umair and welcome back to Realty Solutions, where we break down complex real estate topics and give you the knowledge you need to make smart decisions. Now let's be real for a second. When was the last time you actually read through your entire homeowner's insurance policy? Don't worry, I've been there too. But here's the thing. Not fully understanding your homeowner's insurance is like playing financial Russian roulette with your home. That's why in this video, we're diving deep into the world of homeowners insurance and debunking some of the most common myths that could be costing you thousands. Let's get started. Alright, let's kick things off with a myth that's way too common. Homeowners insurance covers everything. You see, homeowners insurance is designed to protect you from specific perils, think fire, theft, vandalism, or even a rogue squirrel chewing through your electrical wiring. But here's the catch. The specific perils covered can vary drastically depending on your policy and the state you live in. For example, most standard homeowners insurance policies don't cover flooding. And if you live in an area prone to earthquakes or hurricanes, you'll likely need additional coverage for those too. Seriously, I know it's long and boring, but understanding exactly what's covered and, more importantly, what's not covered can save you a world of financial pain down the line. Now let's talk about another myth that trips people up. The market value of my home is the same as the amount of insurance I need. Your home's market value is basically what someone is willing to pay for it right now. It includes the land your house sits on, any recent renovations you've done, and even the current state of the real estate market. But here's the key difference. Insurance isn't about what your home is worth on the market. It's about how much it would cost to rebuild your home from the ground up if it were completely destroyed. This is called the rebuilding cost. Think about it. If your home burned down, you'd need to factor in the cost of materials, labor, permits, debris removal, and a whole lot more. Plus, construction costs can fluctuate wildly, and they're not always in sync with market values. When determining your coverage amount, focus on rebuilding costs, not just the market value. Let's move on to a myth that's near and dear to my heart, especially as someone who appreciates a good investment. We all love our valuable possessions, whether it's a piece of fine art, a rare collectible, or an expensive watch. But are they really protected? Myth number 3, homeowners insurance will cover all my valuables. This is a common misconception that can lead to significant financial loss if not addressed properly. Now, while your homeowner's insurance does provide some coverage for personal property, there are often limits on how much they'll pay out for certain high-value items. These limits can be surprisingly low, leaving you underinsured. We're talking about things like jewelry, fine art, expensive watches, rare collectibles, and even high-end electronics. These items often have specific sub-limits within your policy, which means the payout might not cover their full value. Think of it like this. Your standard homeowner's insurance policy is like the economy seat on an airplane. It provides basic coverage, but it might not be enough for your more valuable items. It gets the job done for most people. But if you're carrying a priceless Ming vase, you're going to want to upgrade to first class. In insurance terms, that means adding a rider or endorsement to your policy. This is an additional provision that increases the coverage limit for specific items or categories of items, ensuring they are fully protected. This basically increases the coverage limit for specific items or categories of items. It's a small price to pay for peace of mind knowing that your valuables are adequately insured. I remember this one time I was at a friend's house, and he was showing off his impressive watch collection. He had everything from vintage pieces to the latest models. He mentioned that he had just purchased a new Rolex and that it was worth a small fortune. The craftsmanship and detail were truly remarkable. Naturally, I asked him if he had it insured on his homeowner's policy. He seemed confident and assured me that his policy would cover it. He looked at me like I had just asked him the most ridiculous question. But when I explained the limits of standard policies, he realized he might need to look into additional coverage. So if you have valuable items, take a moment to review your policy and consider speaking with your insurance agent. It's better to be safe than sorry. Ensuring your prized possessions are fully covered will give you peace of mind and protect your investments. Alright, let's tackle another myth that often leads to disappointment. If my home is damaged, insurance will pay for all repairs. This is a common misconception that can lead to a lot of frustration and financial strain if not properly understood. While it's true that insurance is designed to help you recover financially from covered perils, The actual payout process isn't always as simple as you might think. There are several factors that can influence how much you actually receive and how quickly you get it. First off, remember those deductibles we talked about earlier? These are the initial costs that you, the homeowner, are responsible for before your insurance coverage kicks in. That's the amount you'll have to pay out of pocket before your insurance coverage kicks in. Deductibles can vary widely depending on your policy and the type of damage incurred. Deductibles can range from a few hundred to several $1,000s, so it's crucial to choose an amount you're comfortable with. A higher deductible might lower your premium, but it also means more out-of-pocket expenses when you file a claim. Then there's the issue of actual cash value versus replacement cost coverage. These two types of coverage can significantly affect your payout. Actual cash value factors in depreciation, meaning the older your damaged items are, the less you'll receive in a payout. This can be a shock if you're expecting to replace old items with new ones. Replacement cost coverage, on the other hand, pays for the cost to replace your damaged items with brand new ones, regardless of their age. This type of coverage can be more beneficial but usually comes at a higher cost. Of course, replacement cost coverage typically comes with a higher premium, but it can be a lifesaver if you need to replace major appliances or your entire roof. It's important to weigh the pros and cons of each type of coverage. The bottom line is, don't assume your insurance will cover every penny of your repairs. There are often limits and exclusions that can affect your payout. Understand your policy's coverage limits, deductibles, and how depreciation works to avoid any surprises. Take the time to review your policy thoroughly and ask your insurance agent any questions you might have. Being informed can save you a lot of headaches and financial stress in the long run. Let's move on to a myth that's especially relevant for all the entrepreneurs and side hustlers out there. My insurance will cover me no matter what happens on my property. This is a common misconception that can lead to significant financial trouble if not addressed properly. While homeowners insurance does offer liability protection, meaning it can help cover legal expenses and medical bills if someone is injured on your property, it's important to remember that this coverage is generally intended for personal liability, not business liability. This distinction is crucial because the nature of the incident can determine whether your claim is accepted or denied. So, if you're running a business out of your home, whether it's an online store, a consulting service, or even a dog walking business, your standard homeowner's insurance policy might not cover claims related to your business operations. This means that any incidents directly related to your business activities could leave you financially vulnerable. For instance, if a client slips and falls in your home office, your homeowner's insurance might deny the claim because it occurred during a business-related activity. This could result in you having to pay out of pocket for medical expenses and potential legal fees, which can be quite substantial. Similarly, if you're storing inventory or equipment for your business in your home, it might not be fully covered under your standard policy. This can be particularly problematic if you have valuable items that are essential for your business operations. In the event of theft, fire, or other damage, you could face significant losses. If you're running a business from your home, even if it's just a side gig, it's essential to talk to your insurance agent about getting additional coverage, such as a business liability policy or a home-based business endorsement. These specialized policies can provide the protection you need to ensure that your business activities are covered, giving you peace of mind and financial security. Don't wait until it's too late. Make sure your home business is adequately insured today. Now, let's debunk a myth that often prevents homeowners from filing legitimate claims. Filing a claim will always increase my premiums. It's true that insurance companies use your claims history as one factor when determining your premium rates. A history of multiple claims, especially large ones, can sometimes lead to an increase in your premium. However, it's essential to understand that insurance companies consider various factors when setting premiums, including the type of claim, the amount of the claim, your overall claims history, and even your credit score in some states. In some cases, filing a small claim might not affect your premium at all. The key is to weigh the cost of a potential premium increase against the benefits of filing a claim. If you have a small claim that you can easily afford to pay out of pocket, it might make sense to do so to avoid any potential impact on your insurance rates. Finally, let's address a myth that's all too common but easily avoidable. I don't need to review my homeowner's insurance policy regularly. Life is constantly changing, and so are your insurance needs. Your home undergoes renovations, you acquire new valuables, local building codes get updated, and even the risks in your area can change over time. Ignoring your homeowner's insurance policy is like neglecting regular maintenance on your car. That's why it's crucial to review your policy at least once a year, or whenever you experience a significant life change, like getting married, having a baby, or making a major home improvement. By staying proactive and reviewing your policy regularly, you can ensure that you're adequately protected and avoid any costly surprises in the future. And there you have it, folks. 7 common myths about homeowners insurance debunked. Remember, your home is likely your most valuable asset, so protecting it with the right insurance coverage should be a top priority. Understanding your policy, asking questions, and staying informed are the keys to avoiding costly mistakes and ensuring that you're adequately protected. If you found this video helpful, don't forget to give it a thumbs up and share it with your friends, family, and anyone else who might benefit from this information. And as always, if you have any questions or topics you'd like me to cover in future videos, drop them in the comments below. Thanks for watching, and I'll see you in the next one.